Alphabet Inc., a.k.a. Google, has one of the strongest balance sheets of any company in the world. Few companies can say that they have more cash on hand than total liabilities. Google, of course, is one such company. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. You know, my preference and what I've written or, what I've produced videos on more often than not are good, high-quality, dividend-paying growth stocks. In other words, I use the growth to talk about the company's dividend, but I also use the growth to talk about the company's appreciation. But subscribers to the channel have recently asked me, Chuck, let's talk about more growth stocks. Everybody likes growth stocks. So even though I prefer or concentrate mostly on good dividend paying stocks and good, with good dividend growth, I also like a good growth stock. And growth stocks have some really strong advantages, but they also have some risks. So what I'm going to do here, I'm going to start with Google, and I'll be covering a couple other growth stocks here soon in the series that I'm going to do here on growth stocks. And I'm going to really talk about how I would evaluate a growth stock and what are the most important things. But one of the things I want to emphasize before I actually get into the meat and potatoes of the video is focus on the word growth. Growth and valuation are actually joined at the hip. Valuation is prudence. It gives you lower risk. It's all about being conservative in your investment strategy. But valuation alone isn't what generates the return. It's growth. So it's growth plus valuation is what you want to strive for, I think, as an investor in individual stock. Now, the method of investing in growth stocks is slightly different than investing in dividend-paying stocks, as I've been talking about. In growth stocks, they like to call it growth at a reasonable price. So, I'm going to look at Google here and see if Google is a true growth stock at a reasonable price. So let's go ahead and look at the numbers, and it's kind of do an analysis of Google by the numbers, if you will. So here's Alphabet. I keep calling it Google. I can't get past it. Google is what it's recognized from, but it's Alphabet is the actual conglomerate because it contains YouTube and numerous other acquisitions that the company has made. But the first thing I want to focus on here is the growth. You can see that the growth of operating earnings has been 36.37%. One of the rather interesting attributes about Google is that it's been really profitable almost from the very, very beginning, and its profits grew very, very dramatically. And you can see back, when the company first went public in 2004, that, it was commanding very, very high multiples, 100 times earnings, 98 times earnings. And as I've said before in other videos, you can't really pay too much for a true growth stock. A company that's growing earnings at 15, 20, 25, and even 35%, as Google has, because you can see you could have bought it here at a PE of 85 times earnings on January 6, 2006. And even though the stock has fallen rather dramatically in price this year, you still would have generated over a 15% rate of return, turning $10,000 in over $100,000. But note on this graph, there is no dividend. So the point is, this is all about growth. But I also want to make a point about that. Growth is dynamic. Growth changes. The growth here includes a couple of really big years. So let's shorten the time frame a little bit. Let's go to 20 years, and we now see that growth rate has dropped to 29%, and the normal PE during this time has been about 30. Now, the normal PE is the market PE, how the market has valued the stock. And of course, always remember that's a number, but that number is comprised of some facts. And most of the time, since the Great Recession at least, Google or Alphabet did not really trade at 30 times earnings. You can see that the prices below the orange and the blue line here, which are almost superimposed at this point, that, it really commanded lower PEs, even 13, 14, and 15 times earnings. Because what happens to companies like Google is when their growth begins to change. Now we're looking at, I dropped this down to, since 2006, and now we see growth at 23%. So I'm going to get a little bit more aggressive here and knock more years off. Now we, start at 2010, we've got 18% growth. Still very powerful, very fast. But you can clearly see now 18% at 10 years has been holding up pretty well. I dropped this in the 7 years, which includes the forecasting years, and I've got 20% growth. So Google or Alphabet is clearly a strong growth stock, but it also should be clear to you that the growth of the company has slowed down, and the bigger it gets. It's now a $1.588 trillion company. Now, it's AA plus rated. I showed you the fact that the company has enough cash to pay off all of their liabilities and have plenty left over. And there's very few companies in the world that can actually, say that or have that luxury, have that kind of a balance sheet. But it clearly has one of the best balance sheets in the world. Now, part of that can be attributed to the fact if we move to the all-important operating cash flow, even though this is a non-dividend paying stock, the company has produced incredible cash flow growth as well as earnings growth. And its normal multiple of cash flow has averaged around 20. But again, when you look at that number can mislead you because you also need to recognize that there are plenty of times when it only traded, let's say, 15 or 16 times cash flow, which, currently the company's trading at a blended cash flow multiple of about 16.6. which is, I think, very attractive for this company and for most companies. That's kind of almost a floor. But the question is, what are you going to expect going forward? Now, I also, before I leave the historical graphs here, the company has also generated strong free cash flow growth. And of course, the last thing I'm going to show here on these metrics, I can show all of them, but I'm not going to show them all, is I'm going to look at sales. And you can see the sales growth has been about 29%. So, the reality of it is this is a growth stock, and it's been a growth story. And if you look at performance, if you'd have bought it, when it first came out, put $10,000 in it when it first went public and held it till yesterday's close, your $10,000 would have grown to $449,000. That's a 23% rate of return. And I do want you to note that that's very, very close to the 29% or 28.88% growth that the company has achieved, only discounted by the fact that the stock is undervalued. Okay, so let's look at what can we expect in the future. So let's go back to operating earnings here once. The growth rate has been very fast, but when I take out these massive growth years here, obviously the growth now gets down to be about 23%. And I think this better reflects how the market has valued Google and what its value has been. But remember what I said in the beginning of this video, growth and value are kind of joined at the hip. You can pay value and be prudent and, conservative in your investing philosophy, but it's the growth of the business, once you've bought that fair value, that's going to generate your future rate of return. Now, as far as Google's concerned, for the next year, analysts aren't expecting much growth. We're expecting about a negative 8% growth, followed by double-digit growth thereafter. Okay, so if I go to the custom portfolio, by the way, you could put in double-digit growth rates. You could put in like a 15% growth rate as a logical, possibility here, and see that this would still be a pretty decent 8, 9, 10% investment if it traded at 15 times earnings. If it does trade at its normal 20 to 21 times earnings, it could be a 16% growth. But here's the point I want to make about investing in growth stocks like Google, and I'll be covering others here in the future. It's one thing to learn from the past, and it's one thing to understand. Now, you can also see how consistently this company has grown, how it really almost never had a down year. This could almost not be considered a down year, which obviously reflects why the stock price has fallen. But notice how it's consolidating here. The reality of it is a very consistent producer. It really has some really good economics. If you think about now, they spend a lot of money on, building data centers and so on, and have a lot of technological costs, but their actual cost of goods sold is really very controlled relative to most companies. This company really is almost a money-making machine. It's almost like it has a license to print money. Okay, but if you're looking at what your rate of return is going to be in the future, now that this is a we'll call it $6 trillion business, I think it would be naive to expect it to give you the kind of growth it had in the past going in the future. But it's not naive to think that it's got the ability to continue to grow. So if we look at historical compound annual growth rate for the last 5 years, which is what this fast graph forecasting calculator automatically defaults to, you've got historical 5-year growth of around 26% a year. Now, again, I always like to remind you of this. You want to make sure you're looking at all the data. That is essentially contaminated, if you will, by a 91% growth rate that the company achieved in 2021 coming out of COVID. That was just really an extraordinary year. Acquisitions had a part in that, and there were other factors that had a part in that. But that's also leading to a negative 9% growth. But if you kind of, connect the dots here, this line, smooth this little bump out, the company is continuing to grow. And again, expected to grow at 18% in 2023 and 15%. So going back to the forecasting calculators and looking at historical growth, you have this drop-down window here that FastGraph, you can evaluate all of the growth. And recently, the company's, striving and hitting about something in the neighborhood of 20% growth. So you discount that a little bit, like I said earlier, and you go into the custom calculator and you can plug in the 15% growth that I, did earlier for you, a few minutes ago in the video, and see that this may be a conservative, plausible, reasonable number. This company could still grow at 15% a year. That would make Google or Alphabet an attractive long-term growth holding, but it doesn't necessarily make it a strong, value buy or real cheap. I would call it fairly valued. I would even argue that it might be fully valued still because of the future growth expectations of the company. But I do expect this is a stock that could make you money. And of course, you can just simply look at the historical data based on valuations and multiples. And I think you can agree that this is one of the better valuations. If I'm looking at price to cash flow or whatever, if I'm looking at price to sales, it's trading at one of the lower price to sales, or at least a low price to sales that makes it an attractive entry point. So there's a lot of research to be done on this stock. Everyone knows who company is. You can go into, if you're a FastGraph subscriber, start going in to take apart the company. But the thing that's most impressive about this is the fact that the company's cash is just so strong. I mean, if you look at their total debt, okay, this company can pay off their total debt many times over just with the cash on hand. And again, very few companies can say that. But I think the moral of the story here, what I'm trying to really get across, when you're evaluating growth stocks, you can see that growth drives stock prices. That's crystal clear. But that's the past. You only can invest in the future. So, do your research, go find other sources. You can use the external links from FastGraphs. If you're a member, you can go to Morningstar. You can go to other services, which gives it a 4-star rating. Currently, their 5-star rating on the company would be something, of course, a much lower price, which indicates what I was saying to you before. It's not necessarily dirt cheap, but it's fairly valued for what the company is, and it's a growth stock. And remember, growth stocks have higher risk. In future videos, I'm going to show you how that risk can be manifested when you're only depending on growth. Now, one day, with all the cash that this company's generating, they're going to run out of places to invest, and they're probably going to start paying a dividend. And I think this company is just about old enough to be considering that. You might know that the company recently split their stock 20-for-1 on July 18th. And remember, 20-to-1, that just simply meant for every dollar you had invested in the company, now they gave you 20 nickels. That's all that means. That, the stock value didn't really change, just the price per share to buy the stock changed, but your percentage ownership through one share of stock is 1/20th smaller than it was before they split. That's how splits work. But anyway, that was my presentation here on Google. I hope you enjoyed it. If you did, ring the bell, give me a like, join the channel. We obviously want to see more and more subscribers come onto the channel. And by the way, take a long look and a close look at FastGraphs. What a wonderful investment tool to help you really evaluate a stock by the numbers and be able to see what the company's fundamentals really look like in respect to the company's valuation and how the market may be pricing it. It's been Chuck Harville saying thanks for watching. I'll talk to you guys again real soon.